Greetings and good day wherever you may be. I'm Richard Smith Soto, your expert in all things commercial real estate, and welcome to our weekly informative video. And the intention in these videos is going to be to cover a wide range of topics in the commercial real estate or CRE landscape that will affect you directly, whether you're a mom and pop who owns a couple of multifamily buildings, or you own a sole building that you operate your own business out of, or if you're a large-scale institutional investor with a vast multinational portfolio, as an example. Today's video, we're going to dive into 5 points affecting the CRE landscape right now, essentially. So point number one is the hot topic that's on everybody's mind, which is interest rates. None of us is a fortune teller at the end of the day. Let's be honest. We don't know whether interest rates are going to go up, down, or sideways, and we shouldn't pretend to know. But the best indication right now is that we shouldn't expect any, at least drastic, decreases in interest rates. There's a prediction that for political reasons, perhaps 25 basis points or so, there will be some deduction this year. But the narrative, as far as the Feds are concerned, seems to be centered around higher for longer. Now, the good news is commercial real estate can operate in a high interest environment. For those who've been around for decades, can look historically and see what interest rates have been before. But the challenge, of course, is that they were effectively zero just a mere few years ago. And now, they've effectively tripled in many cases. And so as it stands right now, the average interest rate is going to be around 7.25% for multifamily and around 7.5% for other asset classes. I'm going to provide a link there that dives into that a bit. Now, point number two is surrounding debt and debt maturities. Now, right now, in the next 24 months, there's going to be $929 billion of debt that's going to be maturing. How is this relevant? Well, it's relevant because borrowers are going to be in a situation where they're going to be forced to either, refi and, take debt at an interest rate that is far more significant than what it was, or they're going to need to bring more equity to the table. So inherently what this is going to do is it's going to lend itself to probably an environment where at least a good percentage of these borrowers are going to be forced to trade out of those assets. And then that hopefully should provide a little bit of stimulation in terms of transaction volume for new investors to come in, pump some new blood into these assets, reposition, and hold these assets for the short or the long term. Point number three is that the market is extremely bifurcated, and this is something I talk about often because, of course, as real estate professionals, we're always getting asked the question, how's the market doing? And that's just an impossible question to ask simply because, every market to submarket to asset class is performing differently. I cover a wide range of markets and asset classes. So, for example, you can't compare the office in a central business district like Chicago or New York or San Francisco to the industrial market of Central Florida. They're simply not performing the same. And so you want to be aware of your exact segment and how your specific niche is performing overall. Point number four is that there's undoubtedly new trends in the commercial real estate landscape. I actually see this as very much of a positive. So as an example, I have a heavy multifamily background. That's what I started with in the city of Chicago. That led way into many opportunities to lease apartments and give me an understanding of what tenants are looking for and how we should plan accordingly. So as an example, the work from home trend has had a huge effect on not just office in the sense that companies are now decreasing their needed footprint for office, but it's also changed what renters are looking for in terms of their apartments. They're spending a lot more time at home because they're working from home. And so things like size of the unit is of the utmost important. The functionality of the floor plan, I don't care how nice the finishes are. If you've got very small rooms or you don't have extra space to accommodate for a desk, especially if there's multiple people living in that apartment, for example, you're going to have a big challenge getting that leased up. And of course, what apartments lease for and how they're leased up, the overall vacancy rate is a huge indicator on the performance of multifamily as an asset class, rent growth, etc. Okay, and then the fifth note here is that deals are still getting done. Now, I am a little young for the great financial crisis. At the time, I think I was probably entering college, but those that have been around for multiple decades can surely remember that time period where the distress was absolutely pervasive across every market, across every asset class. Everything essentially came to a screeching halt. And so the good news is that while it could be argued that we're in a little bit of a downturn right now, certainly a shift, if nothing else, there is absolutely still transactions going on. Granted, transaction volume year over year, well, from 22 to 23, transaction volume fell 51%, which is quite staggering. And then from 23 Q1 to 24 Q1, you were looking at a 28% deduction. And as it was for 23 was a slow year after some booming years for a lot of groups on the brokerage and the acquisition front. Now, the good news is, again, capital is always going to need a home. There's always going to be a need for sellers in the marketplace to free up capital and free up equity based on their portfolio strategy. So we're finding that creativity and that little extra elbow grease is the order of the day in terms of moving the needle forward and getting transactions done and consummated. You're seeing a lot of, for example, alternative types of financing, be that through family offices or seller financing, where you may be able to offer a little bit more of an attractive interest rate. And it also helps you as the seller in terms of reducing your immediate tax liability and tax implication. So, like all things, the commercial real estate market is completely and utterly fluid, which I think is something that makes it a little bit more fun and exciting. If you want to catch fish, you go to a pond that has fish in it. So those are our 5 points today. Whatever your goals may be in the marketplace, whether you're looking to expand your portfolio, you feel like you'd benefit from divesting some assets and freeing up some capital, maybe moving on to a new market, a new asset class, so on and so forth. Don't hesitate to reach out to us. We'll definitely help you in terms of getting precise value on your asset and walking you through an exit strategy or guiding you through a process to put quality off-market opportunities even in front of you. That's it for today, and have a wonderful day and week.